Hey guys, okay, here's another video. This is more of a strategy video using the EMA indicator. So the one I'm using here is EMA SMA. On the indicators, let me just see which one it would be. I believe it was this one, Crown's Cave EMA SMA. And then I just set up custom which bands I'm using. So to do that, once you've added the indicator to your interface, you go to settings, and then you can see in the inputs, these are the EMAs. So EMAs, SMAs smooth moving average. So it's basically a simple moving average. It's a little more smoothed out. And then the EMAs, the exponential moving average. And I'm using 10 and 21. These are my two short bands. And then I oscillate between the 50 and the 89. 89 is a really cheeky one that I use for reversals, like from bear market to bull. I find it to be a better gauge of the longer bands. So I don't go with the 50-50 is better, I find, for equities and indices. But 89, 100, and then 200 EMA. And then I use the 10. I don't really use the 30 ever. I would say the 50 is probably a better version. And then the 100 and 200, these are more like equities and like traditional markets, you know. But the one we're using in this is 10 and 21. So you can see I have them highlighted. And the idea is I can't remember. Okay, so the look back period on the 10 is going to be the moving average of the 10 most recent candles, and the 21 is going to be a look back period of the last 21 candles. So the 10 is the shorter or the faster moving of the bands because it's taking less data into the calculation. So it gives you a signal on the 10 when the trend changed quicker than it would for the 21. 21 is more of like a baseline just to see. It's like a health check for the market. If you're above the 21, you're in bullish order flow or bullish delivery usually. 10 is going to be an early indicator of when it crosses over the 21. Like, let me just highlight. I'll just hide this for a moment. So if you only look at the bands, you can see right here, this is where the bands cross. Hold on, I got the magnet on. So right here, you can see this is where the bands cross. This is usually a good signal that the market could be, after a big drawdown, the market could be getting ready to impulse up. Sometimes it'll fake out, but I find the 10 and the 21 are just long enough where it gives you, it kind of avoids fake out moves, right? It still will happen here and then, but for the most part, it's been pretty helpful. The next thing I look for after the cross, I look for price to do a corrective pullback into the bands again. And if it holds the 10 and 21, then it signals to me that the market is actually accepting this expansion move to the upside. So the idea is I look for when price is delivering down and you're in a strong downtrend, you could see we're the whole time we're below the 10 and 21, and the space between the two bands is expanding on the way down, meaning in the short term, the price is expanding down a lot quicker than the smooth average on the 21. And then you could see it kind of contracts here when it's doing this, I guess, corrective move up, rebalance, and then pull back. It didn't take this low. It actually created equal lows on AVAX here, but then here's where you get the bullish cross of the two EMAs. Here's where you get a retest of the two bands. And typically if it retests the 10 and holds the 10, that's even more bullish, because that means in the shorter band, price is being accepted sooner than a deeper retracement. You know, like this retracement here is not even the 382. So if you just pull a fib from low to high, you could see, well, yeah, it's just above the 382. So that's usually a bullish continuation retracement. And then you could see it does the inverse of what it did here. It rides the 10 EMA all the way up, and algos are buying on the 10 EMA all the way up. So very strong. So the best version of this will be after a big drawdown. So the context is big drawdown. Then you have the price squeezing into these two bands. So it's getting very contracted over here, the two bands. and the price is just kind of in between. So this is the candle, this doji, or spinning top, whatever you want to call it. This is where it's really starting to squeeze, and then you could see this big hammer candle, that wick is showing there's a lot of buying pressure on the 10. This is where you want to enter. And then even though this inverted hammer candle rejects, it's still closing above the previous day's high. So this is definitely showing a shift in order flow. And the best version, the best is when you add RSI into the context. So in this case, you could see from this pivot right here to that low, you got a lower low on the price, and then here on the RSI, so the relative strength is increasing, where you have basically this low, and then this pivot is higher, showing that sellers are actually getting exhausted at the bottom, and now you have class A bullish divergence on the daily. So this is a very strong early signal going into the bands that's telling me that buyers are starting to step in. The relative strength of the sellers is cooling off, and we're starting to get a divergence where there's more buyers than sellers going into the squeeze. So that's how I kind of use the two short bands on a squeeze play. 10 and 21 EMA are the two. The indicator is going to be the Crown's Cave EMA and SMA, but then you can change the settings the way I use it. Take a screenshot. These are the EMAs that I'm using, and these are the two that I'm using for this particular setup for a daily squeeze. And then I'm adding in, for context, the relative strength just to confirm that there is a shift in order flow. And the best version of this is after the cross, when it pulls back into the two bands. So hopefully that helps, guys. Let me know if you have questions. All right, cheers.